One of the most common questions I get asked as a financial planner is, should I use Roth or traditional accounts? Tax planning is one of the most important things that you can do over your lifetime. Most people don't understand that your number one or number two expense after housing is taxes, and this is something that you can actually minimize by doing great planning. One of the best ways to do that is by optimizing tax advantage accounts. And that's really what we're talking about here with Roth versus traditional. So let me walk you through the difference of the two. With a traditional account, that means that you are putting money in pre-tax. And when you put money in pre-tax, you reduce your taxable income today. So let's say that you make $100,000, you put in $10,000 into a traditional account, your taxable income is now $90,000. So what this does for you is it saves you $10,000 times your marginal tax rate. So if you're in the 22% tax bracket, you get a $10,000 deduction, you save $2,200 in taxes. But it doesn't stop there. You're just deferring these taxes. You're not fully saving them. You're deferring them to the future. So with a pre-tax account, this money is going to get invested. You're going to pay no taxes on a yearly basis as you sell, as dividends come, as income comes from it. But you're going to pay income taxes in the future when you withdraw this. So you turn 70, you decide to take $100,000 from a pre-tax account. This fills up income brackets and you are going to pay income taxes on that. So you're really deferring taxes from today to the future. How Roth accounts work is that you are choosing to pay tax today but never pay tax again. So same example, you make $100,000, you put $10,000 into a Roth account, your taxable income is still $10,000. That does not change. So this money goes into Roth for the next 20, 30, 40 years, however long you invest for. It grows tax-free. Dividends, capital gains, reselling, there's no taxes on that. And then in the future, when you want to take money out of this account, it does come out tax-free as well. Super advantageous, right? But a lot of times people hear this and they say, oh my gosh, I'm going to put money in Roth because I want to never pay taxes again. And while this isn't the worst strategy, you're not really optimizing tax brackets, right? Today, you are in a really high tax bracket. So a lot of the clients I work with, they're in California, they're in the 37% tax bracket, and they're in a 14% marginal state tax bracket as well. That means they're in a marginal 51% bracket. So if they choose to pay tax today, they're locking in a 51% bracket. If they defer, they're choosing to save by 51% on that. So if they put in $23,000, the max to a 401k, they're saving about a little over $11,500 to the future. And then you say, well, great, but they're gonna have to pay taxes in the future, right? Yes, they are, but in all likelihood, they're not gonna be in that high of a tax bracket, and it's gonna come through at an effective rate. They're gonna pay some at 0, some at 10, some at 12, some at 24, some at 32, and you might get an effective rate of 22 to 24% versus deferring at the marginal rate today. That is the difference of how taxes work on the two. The other things that you need to understand is some rules. Basically, all of these retirement accounts, you really can't touch till after 59 and a half, and then you can take it out penalty free from there. With Roth accounts, you actually never have to take those dollars out. A very unique thing about it. With pre-tax accounts, you do. And this is where the issue becomes if you have too much money. So a lot of my clients are able to defer. And if they don't do any Roth conversions, which we'll talk about a little bit later, then they're gonna get to a point where, let's say they have $10 million and they have to start taking money out at 72. At 72, it's going to say, hey, you're required to take minimum distributions called RMDs based on your life expectancy. So let's say that, you have 10 million and based on future period of time, it thinks that you're going to live to be 100. So it'd basically be 28 divided by that account balance, right? Total random number. Let's say it says you have to take out $600,000 a year. So you might have to take out $600,000 a year. You're going to have Social Security payments. You're going to have dividends and income and capital gains from your portfolio. And that might be combined $900,000. Why is this an issue? Because it's going to shoot you up tax brackets, right? It's going to be filling up a lot of these highest tax brackets, even though you don't need the income. So it's pulling it out, making you have more taxes, and that isn't really ideal. With Roth accounts, you don't have to do that. Plus, it doesn't even end up counting as income. So really big advantage there. So this is then where people say, oh my gosh, even more of a reason to just do Roth. Not true. With pre-tax accounts, there are times where you can do what's called a Roth conversion. A Roth conversion is converting pre-tax money to post. So let's say this example, we rewind and now this person had $5 million when they retired at 50. They are like, oh man, that's a lot of money. Well, what they can do is from 50 all the way till they have to take RMDs or Social Security, they can do Roth conversions. They can convert, a couple $100,000 a year, convert it to Roth. And so now that money can grow Roth free. And what they did is they deferred in a high bracket, they converted in a low bracket, which helped them in the future now stay in a low bracket by not needing as large of RMDs. At the end of the day, between the two accounts, you want to have diversification. You want to have some pre-tax money. You want to have some Roth money. And then you also want to have some taxable money in a regular brokerage account or taxable account. But you don't need to do it every single year. A lot of times when people hear that you want this mix, they say, great, I'll go 50-50, Roth or traditional, and then I'll do some to my taxable account. When in reality, you should be doing this at very advantageous periods of time. So a lot of time, your 20s, potentially your 30s, when you're in low brackets, you're not even in the 32% bracket, probably a good time to consider doing Roth, right? You're in the lowest brackets you'll ever be in. Then you might be in your 40s and your 50s, and you might be in 32, 35, or 37% and say, hey, this is the period of time when I want to actually start deferring money. And then you might retire in your 50s and say, oh, great, this is a really good time to do Roth conversions. When you do Roth conversions, there's a few things that you need to know. One is that you have to pay the taxes out of cash if you're under 59.5. If you withhold on the conversion for taxes and you're under 59.5, that counts as a distribution, which leads to a 10% penalty, something that you probably want to avoid when you can. The other one is that you just want to be really smart here. You want to fill up brackets. A lot of the clients that we have in this space, what we're doing is saying, hey, you have 100,000 of room left in the 24% bracket. Let's do the conversion, fill up this 24% bracket. We don't really want to go into 32, right? Or if you have somebody who's like really low income, maybe it's through 12. If you have people who've been in really high, maybe it is through 32%. You really want to come up with a strategy here where you have a good amount of Roth money, you have the right amount of traditional money, you don't have too much traditional money. And so you need a plan on when to defer, when to pay tax, when to do Roth conversions, and then some different strategies later down the line. That is the difference between Roth and traditional. Both are really amazing accounts. It really depends on you, your situation, your income right now, future expected income, if you'll do Roth conversions, etc. So think hard about this, come up with a strategy, have a great plan, and if you need help, reach out to a financial advisor like myself, and we can help you think through it. Thank you for watching. If you enjoyed this video, please leave a like and go subscribe to my channel for more personal finance content. And as always, please leave your thoughts in the comments below, and I promise to get back to every single one of them. See you back next week.